In this lecture, we will be discussing how to account for inventory. You may have noticed that since learning about financial statements, we're moving down the assets section of the balance sheet, which, if you'll recall, is organized in order of liquidity, or how quickly can the asset be turned into cash. We started with cash, obviously the most liquid of all the assets, and then we moved on to receivables, which are claims to cash, so pretty liquid. Inventory is a little less liquid because it has to be sold in order to be converted to cash. The goal of this lesson is to address two fundamental questions about inventory. First, what is inventory? Not just units on a warehouse shelf, but which goods belong in the account and how do we record when we make purchases of inventory? Second, when we sell inventory, how do we figure out the cost of the goods that we sold? We'll start with the foundational pieces, including different types of inventory and the two systems for recording inventory. Later, we'll discuss how to record discounts and returns related to inventory, how to record cost of goods sold when we sell the inventory, and what to do when the inventory we have isn't worth as much as it was when we bought it. Let's start with the types of inventory. For a merchandising company, that is, a company that simply buys goods and then turns around and sells them for a profit, like Walmart or Target, inventory is pretty simple. Goods purchased from a supplier and held for resale. We only need one account, and it'll increase when we purchase inventory and decrease when we sell it. Manufacturers, that is, companies that make their own goods, like Apple or Tesla, are more complex. They have inventory in three distinct stages, and they need three different inventory accounts as a result. Raw materials are the inputs not yet placed into production: steel, fabric, electronic components. Work in process, or WIP, represents partially completed units currently on the production floor. Finished goods are completed units ready for sale to customers. Costs flow through these stages sequentially. Raw materials are placed into production and become WIP. WIP is completed and becomes finished goods. Finished goods are sold and become cost of goods sold. Understanding this pipeline is essential for manufacturing accounting. And even in retail, knowing which goods belong in inventory is the foundation of everything else. A company like Nike is actually a merchandising company, so they only need one account for their inventories. And here is their inventory balance on the balance sheet, located right below cash and accounts receivable. And because they only need one inventory account, if we put that in a T account, it would look like this: inventory, one overall T account. Of course, Nike would have individual accounts for each type of inventory, but overall, they're going to lump them all together as one line item on the balance sheet. And purchases of inventory would increase the inventory account, and returns would decrease the inventory account, and cost of goods sold would represent a decrease to the inventory account. Now, if Nike happened to be a manufacturing company, they would have more than one inventory account. And let's look at what that would look like. They might have raw materials, and purchases would increase raw materials. And then as those goods were used up, they would be moved into another type of inventory account, which would be work in process. And we would take that dollar amount, all of those raw materials, and turn them into, eventually, finished goods. And finished goods is just like our inventory account up here, where we would have work in process that would go into it, but then when we sold the goods, finished goods, we would record our cost of goods sold as the decrease in the finished goods account. Let's work through which physical units should be included in the inventory account. This is usually pretty simple. You own the inventory you purchase, but what if you decide to return it? Or what if it takes a while to be delivered? The general rule: include in inventory all goods to which the company holds legal title, regardless of physical location. The most common application involves goods in transit. When a seller ships goods to a buyer, who owns them while they're on the truck? The answer depends on shipping terms. FOB shipping point means title transfers when the goods leave the seller's dock. The buyer owns them in transit and should include them in inventory. FOB destination means title transfers only upon arrival at the destination. The seller retains them in inventory until delivered. A second case is goods on consignment. A consignor places goods with a consignee to sell on their behalf. The consignee holds the goods physically, but does not own them. They remain in the consignor's inventory until they're sold. This is easy to get backwards. Third, connecting back to our lesson in revenue recognition and potential for refunds, goods expected to be returned by customers should remain in inventory. If we've recorded an estimate of customer returns, those units are not truly sold yet. Their cost stays in inventory until the return period passes. So looking back at our inventory account, we increase the account when we purchase inventory purchases. So we would debit the inventory account and credit something like accounts payable or cash. That would be our journal entry. As we just discussed, we're also going to include any goods that are in transit. So something that we've purchased, but we haven't received it yet. If it's FOB shipping point, that means it already belongs to us. So goods in transit would also be something that would increase our inventory account. And then goods on consignment, even though they don't physically belong or physically live in our warehouse, they might be goods that we own somewhere else and they would remain in our inventory. Likewise, we might have inventory that is consigned to us that doesn't belong to us. So any goods that we have on consignment that belong to us would be included in our inventory account. And finally, estimated returns. Anything that we expect to come back from us should not be recorded as a sale. So those things should stay in our inventory account. Expected returns. Now, let's talk about the dollar amount, because our journal entry isn't going to be for units of inventory. It's going to be for how much we paid for the inventory. The rule: inventory cost includes all costs necessary to acquire the goods and get them ready for sale. Freight in, the cost to ship goods from the supplier to you, is added to inventory cost. It's a necessary cost to make the goods available for sale. Don't confuse it with freight out, which is the cost to ship our goods to our customers. That's a selling expense. Then, just like our customers have the right to return things that we sell them, we have the right to return our inventory that we purchased back to the supplier. We might also be offered a discount if we paid our bill quickly. Purchase discounts and purchase returns have to be accounted for, and both reduce the net cost of our inventory. We'll work with those through an example later, but for now, know that these adjustments reduce what you actually paid for your inventory and therefore reduce the amount that flows into cost of goods sold. Now, let's talk about how companies record inventory transactions. Two systems exist, and every company uses one of them. The Perpetual inventory system updates the inventory account and the cost of goods sold account continuously with every purchase and every sale. When you buy 100 units, inventory increases immediately. When you sell 30, inventory decreases and cost of goods sold increases in real time. This requires technology, point of sale systems, barcode scanners, ERP software. The benefit is that you always know your inventory balance, which is valuable for operations, for detecting theft or shrinkage, and for timely financial reporting. Most large companies use Perpetual systems today. But all of that technology is really expensive. Imagine how much money a company like Walmart or Target spends on technology to put barcodes on everything and then maintain accurate records of what's in stock at each store. This type of expense is out of reach for a lot of companies, and even relatively large ones. If a company can't afford to barcode everything, then they're going to have to physically count their inventory, but not every day. That would be unreasonable. Instead, they're going to count the inventory periodically to determine what must have been sold. This system is called the periodic inventory system. Using a periodic inventory system, you don't update the inventory account when you make a sale during the period. Instead, you record purchases in a separate purchases account. And at the end of the period, you perform a physical count to determine what's left. Then calculate cost of goods sold as beginning inventory plus purchases minus ending inventory. Both systems produce the same ending balances, assuming that the physical count is accurate. But the difference is when accounts are updated. Let's look at a quick example of the perpetual system versus the periodic system. Under a perpetual system, we would have debited inventory and credited AP or cash for any purchases that we made. So let's assume that we began the year with $100 worth of inventory, and then we purchased 600. So we would have debited inventory and credited AP for 600. So that's our cost of goods available for sale. We have $700 worth of inventory available for sale. Then let's say we sold half of that inventory for approximately $800. So we're going to record that sale during the period. We would debit accounts receivable for $800 and we would credit our sales revenue. We know that we sold $300 worth of inventory because we barcoded everything, perpetually keeping track of inventory. And we can tell that we also need to debit cost of goods sold for 300. And in fact, this would probably happen in our accounting system automatically because of the barcodes triggering the journal entry to be made, debiting cost of goods sold and crediting inventory for $300. So we would see $300 come out of the inventory account. That would be our cost of goods sold. And then we could just do the math and figure out that our ending inventory balance must be $400. This is all in dollars, not in units. That's important. Now let's consider what a periodic system would look like. Just like in the perpetual system, we would also debit inventory for $600 and credit accounts payable when we made that purchase. And when we made the sale during the period, we would debit accounts receivable for $800 and we would credit sales revenue. But unfortunately, because we don't have a barcoded system, we have no idea how much inventory we sold. We simply know what the transaction was for when we sold the inventory. We just don't know that it was half of the inventory that we sold until we go to count it. So looking at this T account over here, the thing that we do not know is we do not know what cost of goods sold is, but we'll have gone out and physically counted the inventory and determined that we had $400 worth of inventory left. And we also have recorded our purchases in a separate purchases account. So it's not actually in our inventory account at all. Instead, we've counted our inventory and we've determined that we have $400 left, and we have kept track of our purchases during the year in a separate account. So we would have put $600 into that purchases account. So now what we need to do, because we've counted our inventory, we know we have $400 worth of inventory remaining. Now what we need to do is we need to remove the beginning inventory and the purchases, right? We need to credit beginning inventory for 100 and credit purchases for 600 so that we can debit and put into our inventory balance the 400 that we know we have now that we've counted it. So let's look at that journal entry. We're going to debit inventory for the $400 that we know that we have since we counted it. We're going to remove that beginning inventory balance of 100 to clean it out because we've counted our inventory. We know we have 400, so we don't need that beginning balance in there. We're going to credit our purchases account because we don't need anything in it anymore. We've now counted our inventory. And the last journal entry is to record our debit to cost of goods sold. And so we can tell that based on balancing this journal entry, we've got 700 here. We need 700 here. We know that cost of goods sold must be 300. Another way to look at it is that when we counted our ending inventory of 400 and we know that we had 700 available for sale, then the only thing we have to do is figure out the math, the algebra, what would bring us down our inventory account down to 400 in terms of what we sold. We must have sold $300 worth. So that's how the periodic system works. We end up with the same amount in our inventory account. We just didn't do it during the period. Instead, we did these journal entries at the end of the period. Let's tie everything together with the cost of goods sold schedule, the standard format for calculating cost of goods sold. Particularly useful when we're using the periodic system and we have to calculate what we sold by counting what we have left. You can see here in this schedule, we've put the numbers in from our previous example where we don't really have any freight in or purchases or discounts, although those would be included in the calculation of cost of goods sold and in the debits to inventory into the purchases account for the periodic system. But here you can see that the math works out where we figure out after we've counted our ending inventory, we can subtract that from what our cost of goods available for sale is to end with the cost of goods sold of 300. Now, there's one critical insight here. Any error in any of these line items flows directly into cost of goods sold, gross profit, and net income. If we count our physical inventory incorrectly, we'll be recording the cost of goods sold wrong as well. The danger is that now we don't really know whether we made a profit or not. Ending inventory errors are especially dangerous because they affect two periods. An overstatement of ending inventory in year one overstates net income in year one and understates it in year two. This is a classic audit concern. Let's review. Key takeaways from this lecture include different companies need different inventory accounts. Merchandising companies, such as Walmart or Target, only need one. Manufacturing companies, such as Apple or Tesla, need 3. Cost flows through these accounts before finally being recorded as cost of goods sold. Perpetual and periodic systems produce the same ending inventory balances. The difference is the timing of the updates. Inventory includes anything that we physically possess, but only if we legally own it. We also include goods that we legally own, even if we don't physically possess them. Inventory costs include anything we had to incur to acquire the inventory and get it ready for sale, like shipping, but we can subtract any discounts that we expect to take or returns that we expect to make.